The South African Reserve Bank targets inflation in a 3 to 6% band. The target number is called headline inflation. This isn't adjusted for seasonality and the often volatile elements of food and energy prices, which are removed from the core CPI figure. The products that make up South Africa's current CPI basket come from the 2005-2006 Expenditure and Income Survey, and the weighting of these products stem from the Stats survey that is conducted every 5 years, the last one being in 2008. Now, the latest CPI figure came in at the top end of the band at 6% year-on-year in March. So in March, the average South African is paying 6% more for the average basket of goods and services consumed. All good and well, but does the cost of living feel like it's gone up more than 6% in the past year? How does your CPI actually feel right now? So that a long introduction to the concept of inflation and what we're looking at right now, which is all about price increases and how that affects basically your bottom line and how much money you have in your pocket. Patrick, good to have you joining us from Cape Town. Let's firstly start off with a look at core CPI versus headline CPI. What is the difference there?
Core CPI exclude volatile component in the basket like food inflation and transport, whereas with headline inflation, it encompasses all goods and services.
Okay, so basically stripping out very volatile aspects of energy and fuel prices. But Quirby, if you just look at how CPI has performed, it's actually been coming down in South Africa. It seems to be quite stable at, 6% right now?
Yeah, I mean, the Reserve Bank targets that range between 3 and 6%, but actually, quite frankly, it's quite difficult to kind of keep it in that band because we're net importers of absolutely everything into this economy, and we literally, take it on the nose as far as oil prices are concerned. We don't set any of those. The fact is that you just have this kind of knock-on effect into the economy on a continuous basis, and therefore it becomes quite difficult to kind of keep it in that band. So as you see oil now dropping, you'll see again inflation coming down, but it can be very, very volatile and quite difficult sometimes to estimate exactly where it's going to be going. Just to show you what the actual weights look like for headline CPI. That's not what the Reserve Bank utilizes in order to gauge the price of inflation. There you can see it. Now, if you look at the blue line running through each one of those categories, you'll see those are the weights that headline inflation at the moment utilizes. Now, I mean, that's getting reweighted as of next year. Now, if you're in a higher income bracket, and let's assume that you're a retired individual, let's assume that you earn quite a bit of money in South Africa, you could see the weights that potentially apply to you. Those would be the black dots that you see there. Look at transport. You're probably paying slightly more on transport than what the average CPI basket potentially will include. Look at miscellaneous goods and services, potentially just slightly ahead of what you're paying in the CPI basket or the weight in the CPI basket. But look at food and non-alcoholic beverages. Look at those. That's kind of the big component. You're paying much less than if you're in the lower income bracket, which is those orange dots that you're seeing over there. And I suppose, Patrick, that's the issue here, is that if you're in a lower income bracket, you're paying a lot more on kind of volatile prices, and hence you're spending a far larger proportion of your salary on food, and that influences these numbers.
No, that's very true. Unfortunately, I think Status A will be in a very difficult position to construct individual CPI. But I think the reality is that inflation differs for every individual. For an example, if one is located in Cape Town, we know that inflation in Cape Town for March came in at 5.5%, which is way lower than headline inflation, and inflation in Northern Cape came in at 7.7%, which is way higher than inflation. So it also depends on where you are located. And if also one looks at inflation for pensioners, just take the average since the inflation targeting was introduced in 2000 until March 2012. One gets the average of 6.2%. Whereas headline inflation over the same period amounted to 5.8%. And that tends to suggest that inflation for pensioners tends to be higher relative to headline inflation. And what that suggests to me is that for pensioners, in order to keep up with inflation, that is faster than headline inflation, they need to be exposed to investment instruments that generate higher returns.
That is obviously the crux of the matter here, is because you're wanting to generate real returns. And I know that you've done some work on a pensioners' CPI. Can you take us through some of the numbers there that you're looking at when it comes to how you construct that CPI index for pensioners?
For pensioners, what I did in 2008, Status A introduced reweighting and rebasing. So to go back in history, I did the splicing and I adjusted the historical data. So I'm using from 2008 up until March of this year, I'm using all urban areas and is linked to metropolitan. And I compared year on year. And if one looks at those numbers, they differ. If one looks at the chart, one could see very clearly that inflation for pensioners tend to be biased on the upside. And one of the reasons for that is that pensioners are more exposed to services inflation, which tends to be sticky. So it tends to be stickier on the upside.
What about medical inflation? Because that, of course, is a big issue at the moment as well.
No, of course, medical inflation is very, very important for pensioners, because after working for the entire of their career, after they retire now, what they want to do is to eat, to travel, and to look after themselves. So they spend more proportion of their income on medical expenses. But if one looks at the graph does tend to suggest that those expenses tend to be also higher relative to headline inflation. For an example, if one looks at medical health inflation, over the period of 2009 to March 2012, medical inflation was quite higher. In fact, overall health inflation, which encompasses medical as well as health services, amounted to more than 7% compared to headline inflation, which came in at about 5.5%.
Patrick, in terms of next year's reweighting and rejigging of the CPI numbers, have you got any views on how that could pan out? Because something like demographically over time, over 10 years ago, the proportion of, let's say, telecommunications in the CPI basket might have been a lot smaller than it is today, with everyone on the internet and everyone using cell phones and things like that. Have you got any views on how this will change? Electricity, things like that, in terms of the proportion that it will contribute to CPI?
Yeah, I think what we are likely to see or during next year when the reweighting is done, I think we are likely to see the weights for electricity increasing significantly, because we have seen electricity rising far above inflation. And if we remember very well when the reweighting was, when income and expenditure survey was done, the previous one, it was 2005 and 2006. There was in the height of boom, the economy was growing well above trend and people were buying a lot of cars. And the current income and expenditure, which is currently taking place, at this time, we are not seeing that coming through. So we are likely to see, probably see vehicle weights coming down quite significantly. And most probably we are likely to see also food weight gaining a significant portion.
So basically, Patrick, is what you're saying positive developments when it comes to that CPI figure and how it is weighted? Because that's what you're saying. Fuel is going to go up as a proportion of the overall basket. Electricity goes up. Even education, medical aid, they're saying that those will contribute more. And that, of course, would mean that the Reserve Bank would then be targeting a number that's more realistic.
No, that's very true. Those will be going up, but I think what is important is, like previously, for example, on electricity, the weight was lower, and it was electricity was increasing faster than headline inflation. And we heard recently that NESA granted ESCOM prices that are far lower than what they granted before. So that should contribute positively towards overall inflation. And food inflation is also expected to slow into next year. And if the weight if the weight for food inflation increases, I think also that should be positive for overall inflation.
Patrick, how does the rand impact pensioners' CPI in terms of travelling, in terms of medical expenses? I'm just thinking that the rand obviously has and will move a lot from previous reweightings in terms of its contribution to the cost of certain imported goods. Have you got a view on what that impact is for pensioners?
Yeah, definitely the currency will always play a significant role in South Africa because South Africa is a small open economy, so imported goods tend to filter through in inflation very quickly. But if one looks at the basket for pensioners, I don't think they are very much exposed to the impact of the currency because they tend to spend more on services, so which is mostly administered prices.
Yeah.
Maybe the currency can come through in terms of what they do in the recreation and when they do traveling and all that stuff.
Okay.
So I think what is likely how is likely to affect them is probably maybe the second round effect.
Okay, so basically we know that pensioners are facing an inflation rate that's higher than the one that's printed by StatsSA. So let's look at what pensioners can do to address this. Kobie, what are your views? If you had to sit down with a pensioner right now, they're looking at their cost of living. They know that they've got a certain amount that's coming through from their retirement funds. How do pensioners or how do people planning towards pension then manage the fact that costs are just going up so much?
You see, I think this comes back to advisory services. And a very good advisor would potentially sit with somebody that's in the retired space and they'd say to them, okay, let's try and understand the cost of your actual living. What is it that you're doing on a daily basis or a monthly basis? And then trying to take some of those things into consideration and just their general kind of lifestyle into consideration in order to kind of set the cost of living specifically to the actual individual. And once you've taken that into consideration, well, you could model around those. So you're not just utilizing the normal inflation number, but you're utilizing something beyond that. When you actually look at it from an investment product perspective, understand that everything in the economy prices from the cost of capital. So you've got CPI at the bottom end of the equation. Then you've got the bank rate. Then you've got the equity risk premium and what you need to earn out of equities and all the other asset classes in between. Another issue that you've got is that you've got to understand that StatsSA has got to put a stake in the ground here. We've got a heterogeneous lot of people in South Africa from a demographic perspective. So you have to utilize that. You have to utilize the number that they come up with, which is a 6% odd number that we're sitting with at the moment. But you can adjust for this from a pensioner perspective once you actually do advisory work.
Roland, what are the best type of products then in terms of investments right now for pensioners who are looking to make returns that are in excess of their real CPI?
I guess the need to have a higher return because pensioner inflation is higher than normal inflation requires one to have a higher risk exposure. So generally you'll find these kind of balanced funds are categorized on a CPI basis, so you get from CPI plus 3 to CPI plus 7 in terms of the range. So if you have, as Kobie says, an advisor who says you are in the upper end of that requirement range, you're going to have to take more risk. Now that's the last time you want to in your life take risk is just, you know, when you need the money the most is expose yourself to high equity prices and then the markets collapse. So generally what you should do in those situations is end up with some kind of capital guarantee product. So you can participate in the upside in the market, but you don't have any downside.
Yeah.
They tend to be a little bit more expensive because you are getting some kind of built-in insurance mechanism in the investment. But those type of investments should be a lot safer.
Because that's the problem, as you wanting to get high returns,
Exactly.
but with high returns come high risks.
And
that's the conundrum.
most funds are not capital guaranteed, so you don't get that kind of protection
But you know,
with general balanced funds.
It actually adds up to the other side of the equation as well. You're sitting with young people who put all their money into cash. And I mean, just take this into consideration. Roland's got twin boys. They're all but 1 year of age now, okay? And he's going to have to start paying for some education now. Quickly look at your screen and you'll see what inflation will cost you if you have to educate kids. That's the blue line there relative to headline inflation. So does it make sense for people with young kids to actually have their money in cash? No, absolutely not. Just by looking at that graph, you'll see
Well,
there.
they certainly won't be able to send their kids to school. And Roland, so you're starting to look at where you're sending your kids to school and the affordability factor.
I'd like to maybe bring Patrick in here in terms of that is the average for South Africa, but regionally, whether you're in Gauteng or Cape Town, I guess there's also a difference. So choosing where you go to school is probably a big factor in terms of what you're going to be paying.
No, absolutely. I think education relative to headline inflation has been very high and consistently. If one looks at the average of overall CPI education from 2000 as well, when inflation targeting was introduced up until March, it stands at 9.5%, which is far higher than 5.8, which is far higher than 5.8. Even if one looks at the latest number, it came in at 9%, which is higher than 6% headline inflation. So it does seem to suggest that cost of educating a child is increasingly becoming more expensive. And what it raises to me is the importance really of savings, and not only of savings in any investment vehicle, but an investor should find an investment vehicle that would really give higher nominal returns that will far exceed these inflation rate numbers.